In this video, you will discover why some of the most powerful ICT strategies, including the Silver Bullet, Cameron's model, and fair value gap execution, all follow the same underlying logic used by institutional traders. Once you understand how liquidity, market structure, and price delivery truly interact, you will stop blindly memorizing setups and start understanding why high probability moves happen before they unfold. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, if you would like to jump directly to a specific ICT strategy or smart money concept, you can use the chapters listed in the video description and navigate to the section that interests you most. However, before we break down advanced ICT models, we first need to understand the core engine driving all of them: liquidity. Because without understanding how liquidity works, why price seeks it, and how institutions use it to execute positions, most trading strategies will simply look like random patterns on the chart instead of structured institutional behavior. Now, consider how large financial institutions, often referred to as smart money, operate when they want to build a position in a currency pair. To execute that position, they need sufficient liquidity, meaning a large number of participants willing to take the opposite side. Without available sellers, buy orders cannot be filled. This is why the market often moves in a way that triggers existing stop-loss orders, providing the liquidity needed for these larger players to enter or exit positions. From a retail perspective, this can feel like manipulation, as price creates moves that appear clear, only to reverse after taking liquidity. This creates a common trap. Many traders believe they are positioned correctly, but the market moves into their stop losses first, takes that liquidity, and only then continues in the expected direction. For a trader aiming for consistency, identifying liquidity on the chart is not optional. It is essential. Liquidity can be classified into two types: static liquidity and dynamic liquidity. And this distinction becomes extremely important when we later look at how strategies like the Silver Bullet identify sweeps and reversals. Let us briefly explain both. Dynamic liquidity refers to the factors that influence market direction and movement. In simpler terms, it represents the elements that drive market movements. To better understand this, imagine a market structure like a rally wave consisting of a high and a low. These highs and lows represent external liquidity. External liquidity refers to the liquidity resting beyond key swing points. On the other hand, the fair value gaps within that range represent internal liquidity. Price is constantly moving between these two types. In practice, the market cycles between internal and external liquidity, moving from one to the other in a continuous flow. Looking at this schematic figure, it shows a rally wave moving upward, sweeping the external liquidity gathered above the previous high. After this, the price shifts toward internal liquidity, indicated by this fair value gap, to fill the gaps left behind from internal liquidity. This movement between external liquidity and internal liquidity is exactly the same logic used inside many ICT strategies. The price then transitions back to the external phase. Essentially, price moves from the fair value gap to external liquidity by sweeping liquidity above this high. With the external liquidity swept, price then aims to rebalance by targeting internal liquidity again, filling the most recent fair value gaps. Now, shifting focus, let us examine static liquidity. Static liquidity refers to specific areas on the chart where a large pool of orders is resting, such as stop losses and pending buy or sell orders. Every time a stop loss is triggered, that liquidity is absorbed by the market. This is why recognizing a liquidity sweep before price reaches a key level is so important. It provides confirmation that your area of interest, whether supply or demand, has a higher probability of holding. Liquidity sweeps are not random. They are part of how the market builds momentum. If price does not take liquidity before reaching a level, it will often use that level itself as liquidity. This is why understanding where liquidity is located is critical for timing and execution. Static liquidity can be identified in several recurring areas on the chart, such as below equal lows and above equal highs, above swing highs and below swing lows, around trend lines and channels, and within or around order blocks. It is also present around support and resistance levels, Fibonacci retracement zones, and near the body and wicks of daily candles. When you consistently recognize these zones, you begin to understand how strongly they influence price direction. Ignoring them often leads to unnecessary losses. Some of these areas attract more attention than others, especially those widely recognized by traders, which leads to a concentration of stop losses and pending orders, increasing the probability that price will move toward them to capture liquidity. Now that you understand how liquidity forms and how price moves to absorb it, we can begin applying these principles inside real ICT trading models. Because once you understand liquidity correctly, most ICT strategies stop looking random and start revealing the same underlying institutional logic. So, what is the ICT Silver Bullet strategy, and why do so many traders consider it a precise intraday framework? The Silver Bullet is an ICT trading strategy that combines three main concepts: market structure shift, liquidity sweep, and fair value gap. When these elements align within specific trading sessions, they create a structured opportunity based on liquidity and confirmation rather than random entries. To trade the Silver Bullet, wait for price to break above the day's high during the London or New York session, and then quickly return inside the range, taking out the buy-side liquidity. This movement above a key intraday level attracts breakout traders, but the fast return inside the range signals that liquidity has been collected. This liquidity sweep above the key structure of the day suggests that a potential reversal may be forming, especially when it occurs during high-volume session times. Next, we wait for a bearish market structure shift to confirm this potential reversal. A bearish market structure shift happens when price breaks and closes below the most recent swing low. This shift indicates that buyers are losing control and that selling pressure is beginning to dominate. In other words, demand is no longer in control, and price may start pushing to the downside with stronger momentum. Then mark the bearish fair value gaps that form during the displacement move as potential supply zones. These imbalances often act as retracement areas where institutions rebalance positions. Set a sell limit order at the beginning of the FVG zone and wait patiently for price to pull back into that area. If new fair value gaps form as price continues to move, you can map out future opportunities. But always follow a clear and disciplined risk management plan to protect your capital. Similarly, in the bullish scenario, the logic simply inverts. Wait for price to sweep liquidity below the day's low during the London or New York session. A valid liquidity sweep pattern forms when price breaks below a key level and then immediately returns back inside the range, signaling that sell-side liquidity has been taken. Next, wait for a bullish market structure shift to confirm that the reversal is valid. Finally, mark the fair value gap created during the displacement and plan your entry accordingly. If the fair value gap is relatively small, remember to use a slightly wider stop loss to give the trade enough breathing room and protect it from normal market fluctuations. At this point, you may have noticed that one concept keeps appearing inside these ICT setups: the fair value gap. It acts as the precision entry after liquidity is swept and structure begins to shift. But to truly understand why these strategies work, we first need to understand what a fair value gap actually represents inside price delivery. So, what exactly is a fair value gap, and why does price react to it so consistently after liquidity is taken? Before we continue building more advanced ICT models, let us break down this concept in detail. A fair value gap is a three-candle pattern that reveals an imbalance in price delivery, creating a gap between the shadows of the first and third candles. This imbalance often appears immediately after a liquidity sweep or a strong, impulsive move, which is why it becomes such an important component inside many ICT strategies. Let us first look at the bullish fair value gap, often referred to as BISI. BISI stands for buy-side imbalance and sell-side inefficiency. A bullish fair value gap forms when the upper shadow of the first candle does not overlap with the lower shadow of the third candle, leaving a clear gap between the two. To make this clearer, let us compare two price movements, one where a fair value gap is present and one where it is not. On the left, there is no overlap between the upper shadow of the first candle and the lower shadow of the third candle, which creates a fair value gap. On the right, the upper shadow of the first candle overlaps with the lower shadow of the third candle. The bearish fair value gap is commonly called SIBI, which stands for sell-side imbalance and buy-side inefficiency. A bearish fair value gap forms when the lower shadow of the first candle does not overlap with the upper shadow of the third candle, again creating a gap between the two. Let us make the same comparison for bearish structures. On the left, there is no overlap between the lower shadow of the first candle and the upper shadow of the third candle, resulting in a bearish fair value gap. On the right, the lower shadow of the first candle overlaps with the upper shadow of the third candle, which means there is no fair value gap present. Another important concept related to fair value gaps is known as consequent encroachment. This simply refers to the midpoint of the fair value gap, or the 50% level of the gap. Fair value gaps can act as areas of support and resistance, similar to other structural levels. In many ICT models, this is exactly where precision entries occur after liquidity has been swept and structure has shifted. Because of this, it is important to observe how price reacts to the boundaries of the fair value gap and to the consequent encroachment level. Let us start with bullish fair value gaps. In an ideal scenario, price reacts at the upper boundary of the fair value gap by trading into it and then closing above it. This behavior suggests that price is respecting the fair value gap. Another valid reaction occurs at the consequent encroachment. In this case, price pierces the midpoint of the fair value gap and closes above it. It is common to see price retest the consequent encroachment shortly after. In the next illustration, you can see the bearish version of a fair value gap reaction. The principle remains the same, but the structure is inverted. Just like other forms of support and resistance, price can also move through a fair value gap and later react from the opposite side. In ICT terminology, this behavior is called a fair value gap inversion. On the left, you can see a hypothetical example of a bullish fair value gap inverting and leading to bearish price movement. On the right, a bearish fair value gap inversion leads to bullish price movement. This behavior closely resembles the classic switch and test seen with many support and resistance levels. Beyond fair value gaps, the ICT method also highlights related concepts such as volume imbalances and gaps. A volume imbalance occurs when there is a difference between the open and close of adjacent candles, even though trading activity exists within that area because the candle shadows overlap. A gap, on the other hand, occurs when there is a complete absence of trading activity between candles. In a bullish gap, there is space between the high of the first candle and the low of the second candle. In a bearish gap, there is space between the low of the first candle and the high of the second candle. In the illustration, you can see the bullish versions of a fair value gap, a volume imbalance, and a gap placed side by side for comparison. In the following illustration, the bearish versions of all three patterns are shown. Keep in mind that fair value gaps, volume imbalances, and gaps can often be used in a similar way when analyzing price behavior and potential reaction areas. Now that you understand how fair value gaps form, how price reacts to them, and how they can even invert, you can begin to see that they are not random patterns. They are part of a much larger liquidity framework used throughout many ICT models. In most cases, fair value gaps become the precision entry point after liquidity has been swept and structure begins to shift. With that foundation in place, let us continue building on these concepts and see how they are applied inside another complete ICT trading model. So, what is the ICT trading strategy known as Cameron's model, and why is it considered such a powerful framework for liquidity-based execution? If you look at the structure on the screen, you can see that this model is not random or discretionary. It follows a clear three-step process. First, identify where liquidity is resting. Second, wait for that liquidity to be taken. And third, execute with precision using a structured entry model. This visual breakdown helps you understand that the edge does not come from prediction, but from alignment with liquidity and timing. At its foundation, this model is built around three core components: a draw on liquidity, a stop raid, and the entry. But what exactly is a draw on liquidity? It is the process of identifying a significant liquidity level that price is clearly moving toward. In practical terms, the market frequently gravitates toward areas where resting liquidity exists, such as equal highs, equal lows, or clearly defined swing highs and swing lows, because that is where clusters of pending orders are waiting to be executed and filled. So, in the first step of Cameron's model, you want to locate a key high or low on the 1-hour chart that price is approaching with intent. As shown in this example, we have a clear swing high on the hourly chart, and price is steadily drawing upward toward that level. We can reasonably anticipate price reaching this high because liquidity is resting there, and the market seeks efficiency. If you cannot identify a clear draw on liquidity on the 1-hour chart, you can refine your perspective by zooming into the 15-minute chart to gain additional structure and clarity. The next step is to identify a stop rate in the opposite direction of the draw on liquidity using the 5-minute chart for execution precision. So now, let us shift to a lower time frame. Keep in mind that in this example, the liquidity zone is positioned above current price. At this stage, we're looking for a swing low to be taken out, which is defined as a stop rate, meaning liquidity is being cleared before the anticipated move. Once that liquidity is removed, the final step is to look for fair value gap formations in order to set a buy limit with structure behind it. If you cannot find any fair value gaps on the 5-minute chart, you can zoom further into the 1-minute or even the 30-second chart to gain more precision and refine your entry. In a bearish scenario, the logic remains consistent and simply flips direction. First, identify a key liquidity zone that price is moving toward. Then switch to the 5-minute chart and wait patiently for a stop raid above a recent swing high. After that, locate a fair value gap and place a sell limit at the beginning of the FVG, positioning your stop loss just above it for protection. Always give price enough room to move naturally within structure, and avoid placing your stop loss too tight, as that can result in premature stop-outs and unnecessary losses. In summary, Cameron's model is powerful because it forces you to trade with structure, patience, and logic. Instead of guessing direction, you align with liquidity, wait for stops to be taken, and execute with confirmation. When applied consistently, this 3-step framework transforms trading from emotional decision-making into a disciplined and repeatable process. Now that we have seen how liquidity is swept and how fair value gaps provide precision entries inside these strategies, we need to place everything within the larger structure of the market. Liquidity grabs, structure shifts, and momentum changes do not happen randomly. They develop within a clear structural sequence that controls how price moves on the chart. And to fully understand why these ICT setups work, we first need to understand the foundation behind price action itself: market structure. The behavior of market movements can fundamentally be attributed to two main factors that consistently dictate the direction of prices: trends, which encompass both uptrends and downtrends, and the consolidation phase, characterized by choppy or ranging markets. Picture this as a perpetual cycle, where prices continuously oscillate between downtrends, uptrends, and consolidation periods, each gathering liquidity and institutional orders. Typically, prices need to consolidate following uptrends and downtrends. A vital initial step when analyzing your charts is determining whether the market is currently experiencing an uptrend, a downtrend, or is in a consolidation phase. To build a robust understanding, let's start with a straightforward overview of market structures before exploring the intricate details of advanced market dynamics. Consider an idealized version of a market structure reflecting a perfect uptrend. I term this as ideal because it's rare to encounter an uptrend in real markets that follows this pattern precisely. Markets don't usually move with such predictability. Nevertheless, to enhance our understanding of uptrends, let's examine this ideal model before shifting our focus to the more realistic uptrend structures that are more commonly observed. In a typical uptrend, prices will consistently create higher highs and higher lows. The pattern generally sees prices surpassing previous highs while sustaining the lows. An uptrend concludes when there is a break below one of the significant lows. To preserve the continuity of an uptrend, it's essential that these major lows remain unbroken. Additionally, when a price exceeds a major high, it results in a structural break and forms a demand zone, indicative of a break of structure, or BOS. Accurately identifying major highs and lows is crucial because it allows us to recognize signals for potential trend reversals or continuations. Without correctly pinpointing these key points, traders are at risk of misinterpreting market signals and potentially entering trades on the wrong side of the market. These principles are equally applicable in bearish scenarios. During downtrends, prices consistently form a sequence of lower lows and lower highs. In such scenarios, prices tend to break below previous lows while still respecting the previous highs. Let's explore the details of a realistic market structure, focusing on the more commonly observed uptrend patterns in the market. Consider a scenario where the price surpasses previous highs, breaking upward. At this juncture, a key question emerges. How do we pinpoint valid major highs and lows? To address this, let's examine the left side of the market structure. It is evident that the price underwent an upward trajectory until it began to retrace. The peak reached before this retracement is deemed the major high. Conversely, the lowest point during the bullish wave that triggered this upward movement and led to a break of structure and a new high is recognized as the major low. These 2 points are the critical external structures of the market, and any structure that develops between them is considered an internal structure. When the price surpasses the major high, marking a break of structure, BOS, it indicates a continuation of the upward trend. On the other hand, if the price drops below the major low, this should be interpreted as a signal of a trend reversal. The internal price actions within these external structures are secondary, provided the price stays above the most recent major low. Maintaining this condition signals that the market remains in a bullish phase. You might wonder why this low at the extreme is treated as the major low. The reason is that it represents the ultimate low point before the price starts its upward trajectory. This particular point is essential as it's the pivotal low that catalyzed the upward movement and the subsequent break of structure. Now, let's transition to the bearish scenario, which mirrors the bullish scenario. The bearish wave begins, leading to a structural break. We also identify a major low, marking the lowest point reached after the structural break. These 2 points, a major high and low, act as our external structures, while all structures developed between them are viewed as internal. Should the price break these major lows downward, it signals a continuation of the trend as illustrated here. Conversely, if the price climbs above the major high, this would be indicative of a potential trend reversal. In simpler terms, the internal price actions within these external boundaries are secondary, as long as the price remains below the most recent major high, signaling a bearish market. As the price retraces upward, it establishes a series of internal highs and lows within our defined trading range, yet it eventually ascends, breaking the recent major low downward. This internal high, situated at the extreme, is now recognized as the new major high because it marks the highest point reached before the price initiated a strong bearish push, resulting in another structural break. Following this, the price undergoes another retracement, forming another major low. After establishing various internal structures, the price sustains its downward momentum, creating a sequence of lower lows and lower highs. Now, let's explore another vital concept in market structure analysis, the break of structure, BOS. You might have come across this term in various trading tutorials, market structure videos, and handbooks. Typically, in a bullish scenario, a BOS is often simply described as a situation where the price surpasses a previous high. However, to accurately utilize this concept, specific criteria and rules need to be adhered to in order to confirm a valid break of structure. Let's dive into these key points and rules. A valid break of structure is confirmed when the price not only breaks, but also closes above the most recent higher high with the candle's body. This validation holds even if the price retraces downwards immediately after the break. In such instances, the market establishes a new major high and major low, defining a new trading range. Should the price then break this newly established major low heading downwards, it suggests a potential trend reversal, indicating a shift from a bullish to a bearish stance, a change of character, or CHoCH. Continuing our exploration, if the price breaks the previous higher high with a long wick or shadow, and the body of the candle closes below the high's range, and if the subsequent candle's wick does not exceed the first candle's wick, this does not qualify as a valid break of structure. In this instance, the resulting low is treated as an internal structure within the trading range. For a reliable indication of a trend reversal or a valid change of character, we need to observe the price breaking below the significant low at the extreme, rather than merely breaking above an internal high. Now let's consider a different scenario. If the price surpasses the recent higher high with a wick, and the body of the first candle closes below the high's range, but the subsequent candle's wick exceeds the first candle's wick, we then recognize this as a valid bullish break of structure. Here, a new major high and a new major low are established, outlining our updated trading range. The internal price action within this defined range is less significant, provided the price remains above our newly established major low, which signifies a bullish market. If the price later breaks this newly formed low downward, it then acts as a clear indicator of a trend reversal or a valid change of character. Transitioning to the bearish scenario, which mirrors the bullish one. For a bearish market structure to confirm a valid break of structure, the price must break and close below the most recent lower low with the candle's body. If the price breaks the newly created major high upwards, this signals a trend reversal, suggesting that control has shifted from sellers to buyers. Conversely, if the price breaks the recent lower low with a long shadow or wick and the candle's body closes above its range without the subsequent candle's shadow exceeding the first candle's wick, this is not considered a valid break of structure. To confirm a genuine break of structure, the price must close below the low's range with the candle's body. Moreover, if the subsequent candle's wick surpasses the first candle's wick and closes above the low's range, this then qualifies as a valid break of structure. We must also update our major low and major high accordingly. As long as the price stays below our newly established major high, the market is considered bearish. Only if the price breaks this new high upward do we acknowledge it as a valid signal for a trend reversal or a major change in character. Having explored various types and scenarios of break of structure patterns, and now possessing a solid understanding of what constitutes a valid BOS, let's delve into another key aspect of market structure mapping, the change of character, or CHoCH. The first step in identifying a valid change of character involves determining the general market direction, whether it's an uptrend or downtrend. Next, you need to highlight the valid breaks of structure on your price chart. In the bullish scenario, consider how the price forms a series of valid breaks of structure. The low and high that define these breaks are our major structures associated with the first valid bullish BOS. As previously noted, any price action that occurs between these two structures is deemed internal. Change of character patterns can be categorized into two types, minor and major. For instance, each time the price breaks any internal low, it signals a minor change of character. It's crucial to understand that a minor change of character alone should not be taken as an indication of a complete market structure shift. Here, we encounter a common pitfall in the market. Many novice traders who have not properly identified the market structure often misinterpret a minor change of character as a signal for a reversal in market direction. Believing that the bullish phase has ended, they might think it's an ideal time to enter a short position. Typically, they place their stop loss just above the internal high. However, contrary to their expectations, after a brief retracement, the price climbs again and continues its upward trajectory. This often results in hitting the stop loss of traders who took short positions. They frequently fail to understand why their stop loss was triggered by the price and tend to repeat this mistake. What they miss is a crucial detail. The price did not break the major low that would confirm a shift in market structure. They should not enter a short position until the price breaks the last major low to the downside. Their perceived change of character was invalid, and the price was merely in its retracement phase before resuming its primary upward direction. To capture a valid market structure shift signal, traders should patiently wait for the price to establish a major change of character by breaking and closing below the last major low that initiated the upward movement leading to the bullish break of structure. Furthermore, it's essential to remember that in a bullish scenario, a change of character pattern is only considered valid if the price breaks and closes below the last major low using the body of the candle. If the price breaks the most recent high with a long wick or shadow and then closes within the high's range, the change of character is deemed invalid and cannot be seen as a decisive market structure shift. This principle is mirrored in bearish scenarios. For a change of character to be considered valid and highly probable, the price must break and close above the recent major high with the candle's body. Any penetration merely by a shadow or wick is regarded as insufficient. To wrap up, throughout this video, you have seen how liquidity drives price, how fair value gaps reveal imbalance, and how market structure confirms when momentum truly shifts. None of these concepts work in isolation. Together, they form the foundation behind ICT strategies like the Silver Bullet and many other high-probability trading models. Once you understand how liquidity is swept, how imbalance is delivered, and how structure confirms direction, you stop blindly memorizing patterns and start understanding the real logic behind price movement. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.